Hello. In this video, we'll be going through the statement of cash flow, the investing activities. As a recap, let's go through what the statement of cash flow looks like. It is a statement that tells the reader the financial statements, all the cash inflows and outflows from the year that occurred for the corporation, and it breaks it out by different types of activities. We have cash flow from operating activities, which using the indirect method takes the net income from the income statement to net income from a cash basis perspective. It basically turns the income statement to a cash basis income statement. And then we have cash flows, whether they're inflows or outflows, from investing activities. And these are activities that occurred for investments, which are typically long-term assets. But if you have a short-term investment, it could be that as well. And then we have the third part is the cash flows from financing activities. And these types of activities include how a company raises money, if they paid dividends, if they issued stock. And then finally, you have the net increase or decrease in cash. It could be either one. In this situation, we have a net increase in cash for $100 from the summing up all the cash inflows and outflows from all three activities. And then we compare it to the beginning and ending balance of our cash account in our GL. And we can see our beginning balance was 200. It increased to 300, which matches the change in cash flows for $100. And then finally, if there are any non-cash investing and or financing activities, they are noted on the bottom of the statement of cash flows. In this video, we're going to go through in detail the cash flows from investing activities and what's involved in there. Typically, investing cash flows is we're going to look at long-term assets and look at the change that occurs within those assets to see what kind of cash impact they had. And also, if a company has a short-term investment, then it will be in the current assets, but also it belongs in the investing activities section. So if a company sells investments or purchases investments in other companies, that's going to be in the investing activities section. And when you think about that, you can think if we invest in another company, and let's just say the company paid cash, the journal entry would be debit investments, credit cash. Investment is a long-term asset. So another type of investing activity is buying or selling property and equipment. Let's say we bought property and equipment, we would debit PP&E and credit cash if we paid for it in cash. And that PP&E resides in the long-term asset section of the balance sheet. Same thing for intangible assets. And then also notes receivable if a corporation say they lend money to one of the employee and they sign a note where the employee has to pay interest on that note, then that's financing an asset, and that also belongs in a long-term asset. They would have a notes receivable and would be investing activity. So again, the statement of cash flow reports all the cash and inflows by type of activity that occurred over the course of the year. Let's take a concept check. Selected information from Shiloh's accounting records and financial statements for 2027 is as follows. Okay, so we're giving a list of transactions. And the question is, on its statement of cash flows, the company should report net cash flows from investing activity for what? So we have to determine which one of these transactions involve a part of the investing activity section, and how do we account for those? First one is cash paid to acquire equipment. So the company purchased equipment. So if they purchase something, it's a cash outflow. So we know it's a negative. It's going to be an outflow of $20. And equipment is a long-term asset on our balance sheet, and therefore it's considered to be an investing activity. And so part of our investing activity is going to be cash paid to acquire equipment minus $20. Second item, treasury stock purchased for cash. Well, where does treasury stock reside on the balance sheet? It resides in the equity section. That means it's a financing activity and we're not going to account for in our investing activity section. Proceeds from sale of land and buildings. Again, we sold land and buildings, which means we have a cash inflow, so it's a positive. And land and buildings is considered investment. It is a long-term asset on the balance sheet. And so we're going to have a positive $45 on our investing activity section. Gain from sale of land. Gain on sale from sale of land and buildings. Any non-cash, any gain or loss from the sale of a long-term asset is going to be part of the operating section. And if the company received cash, any portion of that transaction occurred in cash, right? The company received cash, then the cash component would go in the investment activity section. It's just the gain or loss from the transaction itself is reversed in the operating activity section. Investment revenue received. So investment revenue seems like it would be an investment and therefore in the investing activities section. However, what we reported in the investment revenue is part of net income, right? It's part of our net income. And our operating activity section starts with our accrued net income and we convert it into a cash basis net income. And so since investment revenue is included in the net income number, any adjustments for cash purposes needs to be made in the operating activity section because that's where the investment revenue is residing. So it's in the operating section. Cash paid to acquire office equipment. Well, if we paid cash, it's going to be an outflow. And office equipment is a long-term asset, so we'll be investing. And so we will put it in our investing activities, cash paid to acquire office equipment. Here's my negative $40. And so my net cash outflow for investing activities is a net outflow, right? So net outflow, or oftentimes you'll say net cash used is what it might say, is a negative $15. And that's the answer. We're going to go through some examples of how to account for activities within the investing section, transactions within the investing activity section. And we're going to use this balance sheet and income statement. We've used this in all of our videos for statement of cash flows, so hopefully you're familiar with it, but in case, first thing we need whenever you prepare a statement of cash flows is you need a comparative balance sheet. And comparative balance sheet has the prior year balance and the current year balance for which you're working for. You're preparing the statement of cash flows. And since we're preparing the statement of cash flows for the year ended 2027, we need the 2027 year and the year prior. We need the balances because we're going to have to look at the change in those balances for the long-term asset accounts and any other investment accounts and determine what occurred over the course of the year. So first thing we need is a comparative balance sheet. And we need the current year income statement. And then the third item that we need is any additional information that we need to know in order to account for things properly. So let's get started. First, here's a snapshot of the asset section of this balance sheet. Okay, and we're going to look at the long-term assets. So I'm going to draw this line right here, the not very straight line. And what we have here is land, buildings, equipment, and accumulated depreciation. But we also have this one, short-term investments. And so typically we look at long-term assets, but we can also have some assets sitting in the current asset section. So it's always important to look at that as well. And you can see our short-term assets grew from $0 to $170, right? And we're told in item C in the additional information, right here, item C, it says the common stock of Mazuma Corporation was purchased for $170 million as a short-term investment. So this company, United Brands, bought stock in Mazuma Corporation. So they made an investment in another corporation for $170 million. And so we're going to put that purchase of short-term investment in our cash flows from investing activities, and that's going to be cash outflows because we paid for it. they didn't tell us any other information, so we assume it's cash. If the problem said, they purchased this $170 million for short-term investment by taking out a loan, for $100 and then paying cash for 70, then we would adjust for it only $100. I'm sorry, $70 for the cash outflow. But it was silent on what it did, so we assumed it was all cash. Okay, next we dealt with item C, and now we're gonna deal with item D. Equipment was purchased for $230 million cash. Now, I'm going through these, I didn't read this A through H, but I'm just looking at the ones that would impact the investing activity section. And besides the short-term investment, it's anything that impacts a long-term asset. So equipment is a long-term asset portion of the balance sheet, so I just picked D. So equipment was purchased for $230 million cash. And so that's pretty simple, just because we had a cash outflow of $230 million, and we just say purchase of equipment, negative $230 million. See down here on the bottom right, we're building our cash flows from investing activities section. Now, is that it for the buildings and equipment? We don't know. The best way to see if you've addressed all the items impacting your long-term asset accounts is you have to roll them forward. Okay, so our beginning balance is $760. We just said we had a purchase of equipment, which would increase that balance to $230. And then we know that our ending balance is $840 because we have our comparative balance sheets. Well, something doesn't add up. There's some other transaction or transactions, it could be multiple, that occurred during the year that we need to account for. Okay, so that's a really good check to see if you've addressed everything for every single account, is to do the roll forward. Okay, well, back to our additional information, right? Now we've done this item D. Let's look at item B. It also has to do with equipment, and it says equipment that originally cost $150 million and which had $80 million accumulated depreciation was sold for $40 million cash. So let's just go in here. I already marked it up. But this is the journal entry for that transaction. We received cash for $40. So we would debit cash. We sold this equipment, so we take it off our books at original cost. We credit $150. We debit accumulated depreciation for $80. And then we had a $30 loss on the sale of the long-term asset. This $30 loss was reversed in our operating activities section. If you're not familiar with what I'm talking about, you can go back and look at the indirect method in which we discussed that. But for purposes of the investing activity section, this is what we're concerned with, that we received $40 for the sale of equipment. So it's a cash inflow. Okay. So here, when I look at my bottom right again, I look at my cash flow from investing. I have a cash inflow from my sale of equipment for $40. So now let's do our roll forward once again. I take my beginning balance for $760. I had that purchase of equipment for $230. And now I've sold my equipment that they told us had a cost basis of $150. So I'm going to reduce it by $150. And then I do get to my ending balance of $840. Now, am I done with my investing activity section? How do I know? Let's look to see. I still have other long-term assets that I have to make sure I've accounted for. I have land and accumulated depreciation. You cannot forget accumulated depreciation. Let's roll forward our accumulated depreciation. We started with a credit balance of $230. We sold this equipment and we're told that it had $80 of accumulated depreciation. If we go back to our previous slide, we can see that in this journal entry, we had a debit of accumulated depreciation of $80. The debit would reduce the accumulated depreciation. So here, when we do our accumulated depreciation roll forward, we had a credit. We started with a credit of $230, and then we had a debit of $80, and our ending balance is a credit of $260, right? So we're still missing some component of accumulated depreciation, and we have to figure out what happened. Well, if we look at the income statement, we have depreciation expense for $110. How do we book depreciation expense? Debit depreciation expense, credit accumulated depreciation. So let's go plug in this credit into our roll forward and see if we're done. When we plug in this $110, then we see that our roll forward works and we are actually done. So it's important to do this because there could be some other items that somehow got in there. It could be a mistake. It could be anything. It could be a number of things. So it's always important to do the roll forward. Okay, so now we've addressed item B. Now let's look at item A, where it says land purchased in the previous year for $110 million was sold for $200 million. Let's go back into our balance sheet. Well, we know that we sold land for $200 million, so we received $200 million, so it's an inflow. So we're going to increase our net cash flows from investing and call it sale of land. And let's see, before we can determine if we're done with our cash flows from investing activity, we have to do a roll forward of our land account to see if anything else occurred. Let's see. Our beginning balance is 520. We sold, the cost per basis for this land was $110 million, and our ending balance is 460. It does not roll forward. We are still missing something. So let's go back into our additional information and see what it says in there. What can we find? We can find item E. Item E says land was purchased by issuing 12% 5-year $50 million note payable to the seller. This is going to be a non-cash transaction between the investing activities and financing activities. So this company, right, they issued a $50 million note payable. So they basically acquired land for $50 million and told the seller that, they gave them a note. So they need to pay off the note in the future in 5 years plus interest. So it's going to go into the non-cash transaction portion of the statement of cash flows. But now let's roll forward our land account. So we have our beginning at 520. Now we purchased land for $50 million using a note, and we sold $110 million. Now we're at an ending balance of $460. So now we can be rest assured that our investing activity section is complete. And so now you can see down here in the bottom right, our net cash flow from investing activities is actually a net cash outflow, or sometimes called net cash used, of $160.